Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Whipsaw. Wasn't it just a week ago when all was well? We had good inflation prints, solid retail sales, and supersized bank earnings. Bank of America's CEO said visibility had improved. Then we were reminded of the potential power of the seismic shifts taking place in geopolitics, in the fourth industrial revolution, in the energy transition, in the financialization of the economy and debt expansion. All of these are lurking and for the most part are relatively tranquil. But when any one of them rise up, we get visibility's unwanted friend, volatility. This week our three things are: 1. Oil versus distillates. It's time to focus on what actually drives the economy. And 2. Rising uncertainty. After a welcome reprieve, it's back. 3. U.S. exceptionalism. An update from McKinsey makes the case. All right, let's dig a bit deeper. Oil versus distillates. Out of inertia, I suppose, conventional wisdom tracks the price of crude when thinking about movements in the price of energy. But what matters more is the price of distillates. Gasoline, diesel, jet fuel, the actual products that power the economy. Recent developments in the Middle East and in Russia and Ukraine have added shocks not only to the supply side of crude, but also refining capacity. How that affects credit depends on where you sit. Now, to put some numbers around this, let's start with the price of crude, $92 a barrel today, up 50% from year end. Now let's add in the refining margin. Let's use the 3-2-1 crack spread, which reflects the cost of turning crude into gasoline and diesel fuel. Today, that spread is at or around record levels at $68 a barrel, well above the $16 a barrel average over the past 30 years, and $20 a barrel we saw at year end. Add that $68 to the $92 price of crude and the price of oil products, those which are actually consumed by end users, is $160 a barrel. And that's up from $77 at year end. Not surprisingly, those supplying oil and distillates have been winners. Earnings in the oil and gas sector are expected to grow 140% year over year in Q2, 94% in Q3, and 79% in Q4, according to Bloomberg consensus. On the other side are consumers of oil and its products. And not surprisingly, lower income households and energy-dependent businesses will be hit hardest. When diesel fuel jumps from $3.56 a gallon at year-end to $5.18 today, when gasoline jumps from $2.83 a gallon at year-end to $4.06 today. Now, that's higher fuel costs expected to add $6 billion, or 10%, to United Airlines' operating costs in 2026. But let's keep the magnitude of the cost increase in perspective. The consensus view of United earnings for full year 2026 still expects net income to grow by 10% year over year. And on the consumer side of things, households are much less sensitive to gasoline prices than in prior decades due to higher energy efficiency, more EVs, and higher incomes. According to the EIA, in 2025, when gas averaged $3.10 a gallon, Americans spent less than 2% of disposable income on gasoline. At $4 a gallon, that pencils out to about 2.5% of disposable income, and at $5 a gallon, we're looking at around 3%. At lower income households, of course, higher gas could easily rise to a much more impactful 10% or more of disposable income. But in the aggregate, the actual financial impact of higher gas prices is manageable. But keep an eye on the price of distillates. All right, on to our second thing, rising uncertainty. So over the past 18 months or so, uncertainty has ebbed and flowed on trade policy, on the price of oil, on inflation, on the path of interest rates. After a tumultuous first half of 2025, uncertainty around all of those reduced in the second half of the year. Now, in the first half of 2026, uncertainty around all of those things is back. And let's throw uncertainty around the ongoing rollout of AI on top of that. Now, starting with trade policy, tariffs are back on the table to be tailored for a post-IEEPA world. According to the Budget Lab at Yale, the average statutory tariff rate is set to fall to 9.8% by year end, allowing for the expiration of Section 122 tariffs. Should the administration impose announced but not implemented tariffs under Section 301, the rate will be 12.8%, according to the Budget Lab, at the end of this year. While the threat of tariffs at or around this level is not likely to spook markets based on recent experience, it will heighten concern among investors and the FOMC that progress toward the inflation target could be interrupted, possibly leading to a more hawkish response from the Fed. As far as the risk of an oil price rise, again, we've seen this movie before. There is a greater understanding among market participants that the increase in energy efficiency and the power and speed of workarounds mute the magnitude of any price shock. That said, the current situation is more of a wild card, as the diminished shock absorber of drawn-down strategic reserves, the disruptive impact of additional shipping bottlenecks and reduced refining capacity, as well as potentially adverse geopolitical developments, create more unknowns. And then there is the ever-evolving AI story, where uncertainty is creeping into this all-important economic growth engine. Unknowns related to constraints, most notably power and environmental concerns, regulation, and the competitive landscape, cloud the outlooks for growth and returns, not to mention supply of new debt. All of this points to greater variance in outcomes. The good news offsetting the uncertainty is high confidence that strong earnings are likely to continue, not only over the balance of the year, but into 2027. And for what it's worth, current Bloomberg consensus estimate for the S&P 500's 2027 EPS growth is currently 17%. All right, on to our third thing, U.S. exceptionalism. So McKinsey's Global Institute is out with its latest annual iteration and assessment of what it refers to as the global balance sheet. While noting a number of positive developments around the globe, including deleveraging trends in most countries' household and corporate sectors, the report warns that the global balance sheet has become imbalanced, with asset prices, debt, and wealth rising faster than economic output. The piece goes on to point out that an imbalance usually corrects through some combination of inflation, not good, asset valuation losses, not good, and productivity growth, well, it's preferable. Now, echoing a familiar refrain promoted by Fed Chair Kevin Warsh, the report singles out the U.S. among its developed world peers as being in a productivity acceleration scenario, where higher income supports high asset values and debt. Indeed, U.S. output per hour has accelerated materially since 2023. The development makes a compelling case for a continuation of U.S. exceptionalism. Under a productivity boom, something last seen in the 1990s in the U.S. with the telecom internet phase, productive capacity expands from high investment and tech adoption. Doesn't that sound familiar? In such a scenario, growth typically expands while inflation moderates, although rates remain elevated. Today, we do have what I would call modestly but persistently elevated inflation, largely due to supply-side shocks and the high level of government debt. Nevertheless, the report cites data showing U.S. corporate profits as a share of GDP having soared over the past 2 decades. Prior to 2000, U.S. corporate profits averaged 5.9% of GDP. From 2000 to 2024, that average jumped to 9.2%. Today, we're at 11%. We attribute the improvement to 4 things. 1, technological innovation. 2, globalization. 3, highly effective capital markets that funnel capital to its most productive use across the economy while starving deficient firms. And 4, lower taxes. Now, McKinsey cites 2 factors that could knock the U.S. out of its productivity acceleration phase. 1, falling off of the fiscal tightrope, and/or 2, a significant drop in corporate earnings. On the fiscal point, government debt equal to 120% of GDP theoretically will crowd out other borrowers, raising the cost of debt capital to firms. The importance of corporate earnings growth sustaining becomes clear when considering that, according to the report, equities constitute 40% of household wealth. According to McKinsey, a price correction could result in a sharp pullback in demand, ushering in an extended period of low growth. Risks to corporate earnings growth include something we often highlight, a break in the promise of AI value creation. McKinsey also identifies a large geopolitical disruption as also a risk to future earnings. But let's overweight the positive here, the productivity acceleration scenario with growth and limited inflation. and that's good for credit. So there you have it. 3 things in credit. 1. Oil versus distillates. Now, distillates are well past $100 a barrel, and we're okay for now. 2. Rising uncertainty. Market neutral and up in quality strategies make sense here. And 3. U.S. exceptionalism. Corporate earnings growth is the critical offset to uncertainty. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.